What is going on, guys? I figured I'd do another in-depth look at a Canadian stock, and this time I'll be going over a pretty popular stock and even more popular brand in Aritzia. Quickly, if you do want some commission-free trades on Questrade or some free stocks on Wealthsimple, two platforms that I both personally use and stand behind, links to sign up will be in the description or pinned comment. Also, come join the Facebook group where we talk Canadian stocks and a bunch of other nonsense. Link to join that will also be in the description and pinned comment. But without any further ado, let's get into it. So, like I said, Aritzia is the one in question today. Ticker is atz.to on the TSX. It's trading at a market cap currently of $4.5 billion. So not a huge company, but not a small cap either. So if you have a girlfriend, sister, or daughter, I'm sure you've already heard of Aritzia before, but they're a vertically integrated clothing company that offers high quality everyday clothing. They're traditionally a women's clothing designer, and the majority of their products are definitely catered towards women, but they actually do have an increasing catalog of men's clothing as well. They honestly really remind me of Lululemon a little. And I'm probably going to trigger a lot of girls by even saying that, but let's be honest, there's probably about 9 of you even watching right now, so I'm not too worried about that. But they remind me a lot of Lululemon in terms of, one, their story. You know, being a BC Canadian designer, expanding throughout the States, they make a lot of higher quality, kind of everyday casual clothing. So they position themselves as everyday luxury wear. So a step above mid-market clothing, but not quite designer or anything. Again, very Lululemon-esque. Lots of activewear, around the house clothing, and probably their most popular product, the Super Puff jacket. So this thing's absolutely blown up. It's all over TikTok, apparently. I don't know, I refuse to download TikTok, but apparently it's become a massive trend that almost every girl is feeling like they need to have right now. So naturally, sales of this jacket have exploded through the roof, which has also really put their brand on the map as well. Aritzia kind of has that it factor about it right now. So Aritzia is becoming more popular than ever, and the data proves it. So this is the Google Trends search data for Aritzia in Canada over the past 5 years. If you're unfamiliar with Google Trends, it basically shows the amount of times that someone searched for Aritzia products on Google within a given time frame. And you can really see that over the past year or so, it's really ramped up to all-time highs, meaning more people are Googling Aritzia right now more than ever, and by a significant margin. And that's pretty big for a company that's been around since the 80s. It's the same story in the States too. This is the trends data over the past 5 years for the US. Now, you might look at this fall off right here and think, oh, it's slowing down, but not necessarily. So all of these peaks here are the exact same date as this peak up here. So it's just a much larger one of these. And the date of all these peaks is Black Friday. So obviously, Google searches are going to be a lot higher for this date as people are Googling their website to try and shop Black Friday deals. So I don't really pay too much mind to this fall off here. The point is that it's still at all-time highs by a pretty noticeable margin. So Aritzia's strategy for growth really revolves around 4 things. 1, growing their e-commerce reputation, which they're continuing to invest in going forward, making shopping online for their products easier and easier. 2, geographic expansion, so expanding the provinces they're selling in as well as the countries that they sell their products in. 3, product expansion, so providing their customers with a broader range of actual products to buy. And then lastly, brand awareness and customer expansion. So basically making sure their name's getting out there and it's one that people recognize and one that they really want to buy, which is going to come through obviously marketing. The good thing is that some marketing happens completely coincidentally and completely free. And that's exactly what's happening for Aritzia in a huge way with this whole TikTok thing. People are loving their products and they're going viral on TikTok and being exposed to millions of other people without Aritzia even having to spend $1, which is great. So the growth story that really excites me personally here is the geographic expansion. Aritzia is expanding aggressively throughout the US right now. I feel like I don't really have to explain to too many people why that's such an opportunity. It's obviously got to do a lot with the population and the market size there. There's a massive opportunity for growth. Pair this with their investments they're making into e-commerce, with expanding their product lines and their brand awareness, plus customer growth, you've really got a recipe for potential success there. So this is really going to paint the picture for their expansion pretty well. So they ship products to over 200 countries around the world via their website, but this is a map of their actual physical locations. You can see the amount of states that they're actually not even in yet. Massive ones including Florida, Nevada, and Arizona. What's even more impressive is that 68% of their stores are in Canada right now. If they can scale up to a much higher level of stores in the US, obviously given the population down there, it's a lot easier to do, but you can see the massive opportunity for growth still ahead of this company. Their plans for the next couple quarters are to open 7 to 8 stores in the US and expand 6 of their existing stores to include more products and enhance the experience. They've also identified 100 total locations in the US where they possibly could continue to open up stores. So back to the product line expansion. They're actually planning on doubling their existing catalog by 2024, adding more options for their existing products, and then also new products in general, getting more into swimwear and men's clothing. So now you have a pretty decent idea of their ideas for growth. This is a company that's demonstrated a ton of growth over the past few years and still has a runway of more growth ahead of it over the next few. So the biggest risk for me here with Aritzia stock is that fashion companies are subject to consumer trends. Consumer trends change pretty quickly and sometimes pretty dramatically when it comes to fashion. Like I remember when Hollister, Aeropostale, and American Eagle were super trendy when I was in elementary school. After a couple years, they weren't cool anymore. I'm no fashion expert, so it's hard for me to predict whether or not Aritzia is going to have the same buzz about it 5 years from now. My guess is that they probably will, but I want to factor that into my decision to buy the stock, the risk that this company might not be as popular as it is right now in 5 years. Like if their super puff jackets eventually become lame because too many people have been talking about them on TikTok and everyone owns one, so naturally people try and find the new thing and move on from it. Does that impact the revenues massively? That's a potential thing that could happen. Now you look at the company's management and their goals and their desire to innovate and produce new products and expand on their products, and I see them adapting before that completely changes, but you never know. So if you potentially see my buy targets a little low from what you believe might be a reasonable buy, that's a lot of what I'm kind of factoring into my decision. So let's take a look at their financials, starting with their balance sheet, just to make sure they're in a decent financial position and bankruptcy isn't too much of an issue anytime soon. So they've got a positive current ratio with a decent amount of cash on hand, meaning bankruptcy likely isn't a scenario over the next 12 months. They actually don't have any long-term debt at all, which is great. Yes, that's correct. That's not just Yahoo Finance being dumb. They have zero debt long-term. The majority of their liabilities are from long-term leases, but given their strong, growing free cash flow, I'm not too concerned about their ability to pay these off. This company isn't going under anytime soon. Moving on over to the income statement, revenue is growing double digits every year, with the exception of 2020, obviously due to the Cove, that's understandable. Net income's the same story, and so is free cash flow, which you guys know I value a lot more than net income because it's a lot harder to manipulate, and it kind of paints a more accurate picture of business performance. So from a fundamental standpoint, everything looks great here. Now comes the all-important valuation side of things. Because remember, this company's been growing really nicely, and they have a really great story. But we just want to make sure we're not paying a stupidly ridiculous price because they're growing and they have this story. We want to make sure we're paying a fair price. And if this doesn't really make sense to you, go watch my other video called The Most Important Thing to Know When Buying Stocks. I'll link it in the description as well. But it really paints a picture of why valuation really matters and that you can actually pay way too much for a company just because it's growing. And it's actually a pretty common thing that a lot of people do. So let's look at the valuations for Aritzia. So right off the bat, a PE ratio of 54 makes me cringe a little bit. 54 is a pretty damn high PE. This means that you're actually paying $54 for every dollar that Aritzia actually makes in net income. Really think about that. You're paying $54 for $1 of Aritzia's net income. It's definitely got a rich valuation for sure. Now, does that mean it's not a buy? No, not necessarily. Aritzia is growing really fast and, like we talked about earlier in the video, still has a massive runway for future growth ahead of it. If we think that Aritzia is going to keep growing fast enough, we can use this to justify that PE ratio, and I'll get into that in just a little bit. But looking more into the valuations here, a forward PE of 33 tells me that earnings are expected to grow massively over the next 12 months. So they are still expected to grow pretty substantially, which makes me feel a lot better about their PE ratio. If their PE ratio is 54, and their forward PE was 48 or something, that would be kind of a pretty big red flag to me. But there's also one thing that trumps all of this. You guys know I care a lot more about free cash flow than I do earnings. Like I said earlier, I think it paints a lot more accurate of a picture of operations. So their price to free cash flow is 29. So you're only paying $29 for each dollar of free cash flow, as opposed to the 54 for each dollar of earnings. So I kind of like to look at price to free cash flow as kind of the real PE ratio. So 29 times free cash flow isn't terrible at all for a company growing like this. It's still up there, don't get me wrong, 29 times free cash flow isn't cheap by historical standards. The market historically trades at a price to free cash flow and a price to earnings ratio of around 15. But keep in mind, because interest rates are so low, that justifies valuations being higher because stocks are really the only marketable security that you can actually make a decent return on right now. So the demand to buy stocks is higher, which means naturally, those prices are going to get pushed up higher as well, which in turn leads to higher valuations. So the average price to free cash flow of the market itself right now is almost 35, which is just insane. Keep in mind, historically, it averages again around 15. It just kind of speaks for the state of how overvalued the market kind of is right now. So there's two things to take from this. The first is that Aritzia is trading at 29 times free cash flow, which is less than the entire stock market is. We know that Aritzia is growing really nicely, so it actually on face seems like a really nice deal. But one thing we have to keep in mind is that this inflated market can't keep going on forever. Interest rates are eventually going to rise, and probably within the next couple of years. So therefore, valuations are going to fall over this time as the money flows out of stocks and back into bonds. So when we do projections for Auritzia in the future, I personally want to factor in a margin of safety here. I'm going to assume it's going to be trading at a much lower price to free cash flow ratio in the future, just to account for any sort of correction that might happen in the market. Hey, if no correction happens, I'm massively rewarded. But if a correction does happen, it's already baked into my projections, so I'm not hurt too bad by it, if at all. So when I show you my discounted cash flow model, which I'm going to use to determine a price that I want to buy the stock at today, I'm going to use a much lower multiple of free cash flow than the one it's currently trading at. So let's transfer on over into my model and see what price we should be buying the stock at right now, and see if Auritzia is currently a buy or not. Alright, so here's my model for Auritzia. You see we got the stock ticker and the price imported up here. This is a discounted cash flow model. Here's your discounted cash flow. So, you can see all these numbers are actually discounted if you look at the formula up there. I'm not just, this isn't just some like magic calculator. You guys know what's actually happening here. Okay, so here's my assumptions. I'm assuming revenue is going to grow at 15% compounded for the next 5 years. So I've gone with 15% revenue growth, time frame of 5 years. So 2021 was obviously a huge year, and I don't really expect that to be the same picture going forward. I think it might have been an anomaly caused by demand. Their products going viral on TikTok, people having a lot of money, people getting out, the world opening back up. Over 2020, people weren't buying too much clothes because they were at home. They didn't really have a reason to. They were in the same kind of casual clothes every day. Now with the world kind of opening up, people are obviously, retail's thriving. People are buying stuff again. Analysts kind of expected an increase of 17% revenue for 2022. So I kind of had this slowing down, tapering off, 17%, 16%, 15%, 14% throughout the next 5 years. So free cash flow as a percentage of revenue, I went with 17%. So in 2021, this past year, they did just around 16.9% free cash flow as a percentage of revenue. I went with slightly higher because they do plan on prioritizing profitability going forward. So I want to assume they're able to become more profitable. 17% is a lot higher than their historical average. So this isn't the most conservative of assumptions, but given how much they are prioritizing profitability going forward, I think it's fair. I think it's fair to assume that they can replicate their 2021 results going forward, especially given the inflation we've seen and the increase in a lot of, raw material costs. For them to still convert 17% of their revenue as free cash flow is pretty impressive. So I think this is a safe assumption to go with going forward. Share percent, I have increasing 1% per year. Their share issuance or buyback was kind of all over the place. Some years they issued, some years they bought back, but it averaged out to about 1%. So I used 1% for my model going forward. And then the all-important multiple. This is really the biggest variable here. Like I said, I'm going with 20 because I want something much safer. Like I talked about earlier in this video, the market's trading at all-time highs right now. So we talked about a price to free cash flow of 36 for the entire market. Like I said, I want to bake in a margin of safety here. In case there's a correction over the next 5 years, which I believe will happen, I really do believe that interest rates are going to start to taper up pretty significantly over the next 5 years. So I'm using what I believe to be a pretty fair multiple. So 20 times free cash flow when the market historically trades at around 15 times free cash flow. So we are still paying a premium for the stock. It still would be a lot more than the market. And you'd expect that because, one, it's growing revenues double digits pretty nicely. And two, certain companies like Lululemon, certain companies kind of demand a higher PE ratio, which I don't necessarily agree with. I don't think should happen. I don't think you should pay more money just to own Coca-Cola or Lululemon just because of that brand. But it's the way the market tends to do these things. So I'm baking in a pretty safe price to free cash flow of 20. So I went with a desired return of 15%. Now, why did I go 15% in particular? Because you can get an 8 to 10% return with zero risk by just simply buying index funds. So to take on the actual individual risk of buying an individual stock, where these projections could be wrong and not work out, give yourself a bit of a reward, give yourself a bit of incentive. So if my projections work out nicely, I'm going to beat the market by 5, 6, 7%. So that's why I always go minimum 15. If you want to go 12%, whatever. But I like to go 15. So with all these assumptions, the price you should be buying Aritzia today is at $45. It's currently at, actually, I think it's currently at around 51. So, whoops, let me just change that. So, it currently has to fall about 10-ish or so percent for it to be a buy for these assumptions. Now, you might argue personally, this all depends on your assumptions. If you want a 12% return, it's almost a buy right now. So you're still going to be beating the market. So if it does exceed what I believe to be conservative assumptions, you'll probably make more than that 12%. I want to go with 15 because I'm greedy, honestly. I'm a greedy dude. I want the highest return I can possibly get. Now, if you're saying that 20 times free cash flow is way too conservative, this basically equates to a 20 PE. If you think that's way too conservative, we can try 23. And again, it's almost a buy, even with these assumptions for a 15% return. If you're a lot more bullish on Aritzia, you say 25. It's a great buy right now. You're going to exceed that 15% return. And now, if you think they're going to be a little more profitable, you think that's going to translate in 18% of revenue flowing down to free cash flow, and you think revenue is going to grow a little higher, you think it's going to grow 17%. The stock is a steal right now. Why I don't like to do this, why I don't like to get ultra aggressive is if none of this works out and I'm buying this stock at $62, these are pretty aggressive assumptions. There's a good chance that these don't work out if anything, externally bad happens that could even be completely out of the control of Aritzia. If any of this happens to impact these, I'm not going to get that 15% return. So my job is to make really conservative assumptions, so 15%, 17%, and a 20 PE ratio. I'm happy buying the stock around $45. Preferably, I'd love to do it under, but I'm happy buying the stock around $45 a share right now. Because if my assumptions, like I said, which I believe to be pretty conservative, work out, I'm still going to get that 15% return. If things are going great for Aritzia in the future, my return is going to be a lot higher than 15%. Like if I buy at $45, if it gets there, and, it ends up trading at a 25 PE ratio, and revenue grows by 18%, it's going to be trading at a $12 billion market cap instead of what was in 8.7. So my return's going to be a lot higher than 15% in that case. I'd rather be positively surprised than, have things go bad and not make that 15% return and me going, why didn't I just invest in index funds? So that's my whole kind of philosophy on doing these models. I like to be conservative and I like to apply a pretty higher desired return. But there's your buy target right now. According to my assumptions, $45 a share is where I'm looking to get in. If you're really bullish on Auritzia, it could be a buy right now in the low 50s. So here's JP's buy targets for Auritzia. Remember, these are my buy targets, not yours. I've got it as a buy anywhere under $46 a share. If you really want to own this company and you're super bullish on Auritzia, it could easily be a buy right now for you in the low 50s. Like I said, if you use my relatively conservative assumptions and just want a 12% return, which is still beating the market, it's a buy almost right now. And then combine that with a bit of more aggressive assumptions and this thing's a great buy. So if you buy right now in the low 50s and it keeps falling, you should keep on buying because it's really just becoming a better and better deal for you. Now, anywhere under $42 and the stock becomes a great buy for me. And I'm going to be personally buying a little bit more aggressively. And anywhere under $36 and the stock's an absolute steal in my opinion. And I'm trying to load up the boat. Now, there's a great chance it never gets to each one of these prices. But that's totally fine with me if it doesn't. There's 10,000 other stocks for me to choose between. I want to be patient. I don't want to hop into something just because I like the story. If I miss out, I miss out. There's other opportunities there and there will continue to be more opportunities in the future. But also keep in mind that things happen. Also, the stock's gone on a pretty massive run recently over the past year. It's honestly pretty reasonable to assume that there might be a natural correction soon as some people start to take a bit of profits and sell a bit of their shares of the stock. And it doesn't need to get to $42 for me to start buying. I'll just be prioritizing it a little bit more than some other stocks if it does happen to get there. Like I said, I'm not against adding the stock under $46, around $45. But with that being said, that's been my time, and I thank each and every one of you guys and gals for yours. I hope you guys enjoyed this video. If there's a stock that you guys really want to see, let me know. Like, I'm not going to do a massive video on so-and-so company with a $100 million market cap just because one of you guys keep commenting about it. I'm either going to do a video about stocks that personally interest me, or if I see a lot of you guys commenting about one stock, I'll do a video on it. Like Lightspeed was one of those. I got a lot of comments on that one. But appreciate it again, as always, and take care, guys.